You're listening to What's Up Digital Lending, the podcast that explores the exciting world of digital lending. We make a deep dive into the most important issues and talk to the leading minds of the ecosystem.
Hi everybody, my guests today in this episode number 20 are Ariane, Sophie Dallmann, Senior Manager at PwC, Fabian Platzen, Managing Director at iwoca, and Niclas Storz, Founder and CEO at Tidally. My name is Constantin Fabricius and I have the pleasure to host the show. In this episode we talk about embedded lending for the very first time. Truly, there has already been a lot of buzz about this topic around. Until now, however, the question has always only been what this means to banks and associated service providers. As you know, we do things differently on our show. We're always interested in the whole picture, and that includes non-bank digital lenders. So listen up. Embedded lending opens up new perspectives on the customer interface and requires a shift away from traditional models. So far, so good. But why is that? What role do customer expectations, the financing gap, and in particular regulation play? How will Basel III and the emerging FIDA, the Financial Information Data Access Regulation, affect things? Is embedded lending, in the end, perhaps just another word for disruption at the customer interface? Today, three wonderful and very seasoned experts will give an answer to this pretty important question. Before we start, however, listen carefully to the following, please. The content of this podcast is expressly not to be considered investment advice, but is intended solely for your information. We do not assume any liability and will not share any profits. Okay, Ariane, Fabian and Niclas, welcome to our 20th show.
Thanks for being here. It's great.
Good morning. Hi.
Yeah. Thanks for having us.
Perfect. Folks, please tell us a little bit about yourselves. Who are you and which company are you representing today? Ariane, would you like to start?
Yeah, of course. So great to be part of this today. I'm Ariane, Senior Manager at PwC in the FS advisory team. So yes, one of the big four, from advisory to audit, tax and legal, with many colleagues. So I couldn't count them. My focus is on strategy, payments, embedded and especially open finance, namely FIDA, mostly within strategy and transformation projects. I've worked closely with banks and FS providers for years, and so I'm quite aware of their strengths, of their challenges, and their internal cultures. So what's on my mind is about what really works out for them, for banks, for the customers, and I would say for everyone building the space in between this ecosystem.
Great, thank you very much. Who's next? Niclas, Fabian.
Yeah, I can give it a go. So I'm Niclas. I'm founder of Tidally. I'm 54 years old, and before I had the crazy idea of founding Tidally, I spent my first 25 years in management consulting, 5 years with A.T. Kearney, and nearly 20 years with Boston Consulting Group. As a senior partner in BCG, I was running two different business segments globally. The first one was called Tech and Operations and Banking. That was all about automation, digitization of processes end-to-end, including lending business and credit business. And then the second stream I was in charge for was called Transaction Banking Payments. That's retail payments, wholesale payments, cash flow management. Actually, end of 2019, I got a little bit bored of standing at the sideline and watching others playing on the pitch. So I went to my wife and said, darling, I'm going to quit my job and I'm going to found a fintech. I must admit she was a bit puzzled when I came to her. We are still married. We still speak to each other. And then I started a completely new journey. I closed the book of being a consultant and started building Tidally. And we are a cash flow management solution, helping SME clients actually manage their liquidity and their cash flow by uploading bank transactions and open invoices and then doing forecasting and categorization. So we help them on the one side to really manage the cash flows, but we also help non-bank lenders, but also banks in order to provide digital cash flow information into the lending process. And that's maybe one of the areas we want to talk about, that we help actually to run down the path of innovation and disruption. And last but not least, I have become very humbled after 25 years in management consulting running a startup, building a company is a very, very different thing, but it's a great experience, I must say. I'm very glad that I had the courage to do this 6 years ago. And great to be here, Constantin. Thanks for the invitation.
Yeah, thank you. Fabian.
Yeah, thanks for the invite, Constantin. Fabian, I'm general manager for iwoca in Germany. iwoca is one of the largest digital lending companies in Europe. We're active in the British market and in the German market. And actually, we are an on-balance sheet lender, meaning handing out our own money to our customers. A bit like Niclas, I also have a career with a different background. I started in regular banking in the early 2000s, was working for German banks and for an international bank for roughly 15 years, more advising customers on how to structure lending facilities, doing larger loans. And then one of my customers asked me to join them, become a fintech person, joining the fintech industry. Did that in 2018, moved to Berlin, was scaling a fintech here in Berlin. And then had the chance to join iwoca in early 2023, and quite happy that we did that because ever since we're doing quite well in the German market, also in international markets, and happy to be there, and therefore also happy to be here today, talking with you about what's going on in digital lending.
Yeah, thank you very much. So many interesting backgrounds. You are a perfect fit to this show, guys. Really great. Great to have you.
The pressure's increasing, Constantin. The pressure's increasing.
So, okay, let's jump into our discussion, and let's start with a simple question to warm up. What are the current trends in embedded lending in the SME sector?
So what do we see as trends in embedded finance, embedded lending? One of the trends that we're seeing is that actually the interest of platforms, of other players to integrate finance solutions directly into their systems is increasing. So embedded lending, I think, is a trending topic for nearly a decade already. It's not a new phrase. It's not something that is popping up just now in the market. Yet what is becoming more and more relevant is the deeper technical integration. We all know things like API integrations and stuff, also stuff that we have been talking about for years and years. Yet only now we're seeing that there is sufficient ways to do that there's user journeys, UI experience for customers that is actually fully integrated. So where you have the kind of one-stop solution, and that's what our customers want to see and what our customers are also looking for. And that's where only now we're actually seeing quite a trend in more and more partners looking for embedded lending, embedded finance partners. And the other thing that I would say is quite relevant is that with topics like open banking, better access, again, API playing a big role here, better access to transaction information, for example, when cooperating with payment service providers or with trading platforms, the data that you can get from your partners to then have a stable and better than direct credit decision is also adding value. So what we see, for example, with embedded lending partners, embedded platforms, is that our risk profile on those platforms is a bit better than when we assess a customer directly out of our own data or data that we so solely our own data or data that we can generate through official third-party partners. And that's where an added value again also for the customer arises. Why? Because we can then just approve more customers on a like-for-like profile compared to seeing them in the direct channel. And that's why we are definitely a big fan of seeing more and more embedded lending partners coming, and where we also believe that there is a big market potential for the trialogue of direct acquisition, meaning partners coming directly to players like iwoca, like us, embedded lending, and then the typical partner introducer business that we still think is also quite relevant in the market. But the embedded lending is definitely the area where we see the most interesting growth at the moment.
And another trend I'm seeing, maybe 2 or 3 trends, including one example, is that what used to be like a race has turned into corporations. So more and more banks and fintechs are teaming up. And that combination, in my point of view, makes definitely sense. Banks bring the capital and compliance, and fintechs bring the tech and speed, just like you mentioned earlier. Just look like, for example, banks were partnering with Lieferando and Rabobank. And what I also find very interesting is a new trend, that loan offers find the merchants proactively. So not the other way around, a push into the market. For example, I think eBay Germany and Uland offer funding right in the seller dashboard. So they don't need to apply. They just have like an literacy check in the background, and the seller logs in and the offer already is there without having asked for it. So that's not just convenience. It's like, reaching the SMEs who never thought they would get a loan or they could apply for a loan within the eBay surface.
Just have to mention it here, Aria, that we're partnering with eBay for a couple of years already. So even though the Uland press release got quite some market attention, but we're also with eBay for quite a bunch of years already.
Yeah, maybe to add what you, Ariane, Fabian, what you said, maybe an additional comment on my side is, first of all, I find it quite interesting to see that lending business has become super attractive again, right? You had recent years where, I'm talking a bit more out of the perspective of the banks, but they were quite, I would say, cautious about how to grow the assets on the balance sheet, right? So they were really, I would say, quite careful. And I see over the past 3-4 years that this dynamic has completely changed. Having said this, I think, and that's maybe one of the struggles that I see, and I know the banking space quite well because I spent there 25 years in trying to help banks to optimize their operations and technology, etc. But I think there are two things that really, where banks are struggling, and which actually is also a pretty disruptive problem they are facing. There's a higher, I would say, customer expectation about instant credit, about speed of loan, disbursements and things like this. That's one thing. And it's not that easy for these incumbent players to actually cope with that expectation. And the second one, obviously, is if I now turn around and look into the future, I think we see pretty heavy macroeconomic environment. So the banks are on the one side, they want to push their credit business. On the other side, they're super scared about increasing loan loss provisions. So the quality of scoring the individual credit application has become of utmost importance for the banks. And that's also a second thing. In theory, they have a lot of data lying in front of them. But the problem is the way they get the data is so diverse. I mean, it's like Apple Pierce Kangaroo, right? They get PDFs, they get Excel models, etc. And then they try with big credit operation teams to try to score. At the same time, they know that clients expect this in real time and with high convenience. That's a big struggle for banks. And that's also what you're saying, Ariane. That's the reason why banks are more and more opening up towards teaming up with fintechs. And at the same time, it's really pushed them under enormous pressure because they have a huge architectural complexity, and building in partnership with fintechs is not that easy for them, right? But other than when I spent my time in banking as a consultant, banks naturally said, we do everything on our own, right? We want to do this captive. And now they realize they simply don't have the chance to cope with the speed of disruption. So they need to team up. But they have other challenges coming up in terms of how to bake the partnerships into their existing operating model.
Okay, great. Let's work this out in more detail, please, as I have a few points here. And let's start with the customer expectations. How exactly have they changed over the past couple of years and influenced this development that you have just described accordingly?
Maybe if I can make one comment on this one, I would say when you look back some decades ago, let's say 10, 20 years ago, I think there was an imbalance of power. You had the corporates, and I assume we primarily speak about SME clients. They were going to the bank and they had a pressure and need to get funds from the banks. Okay. So it was an imbalance. I mean, banks were sitting on huge, assets, and there were a lot of SME clients begging, getting loans, which were mission critical for SME clients. Okay. This is a real imbalance. Now, the possibility with technology that these SME clients simply they have alternatives towards getting loans and lending and funding, right? And these alternatives, actually, when you realize as an SME client that you don't only have to go to a bank, but you can also go to various other providers, be it non-bank lending providers, be it other platforms, and you actually have the chance to get the loans there and at a much better rate, at a much higher speed, that disruptively changes everything, right? So the imbalance, which I perceive like this, has now actually leveled out, okay? And I don't know if we can say that the SME clients is actually having the power now. I wouldn't be that drastic and radical, but at least this radical imbalance between banks and SMEs 10, 20 years ago has vanished. And I think that is actually changing the rules of the game.
Yeah, fully agreeing with Niclas here. I would add one topic, what we're seeing, and I think we all know it also from ourselves as private consumers to banks. Like 20 years ago, 15 years ago, the loan, the credit was the anchor product for every bank to actually win and hold a client relationship. So, the good old wallet size discussion, the bank that was having the loan was normally also dominating the wallet of the customer. We all know that nowadays with more digital onboarding, it's easier to, even as an SME, to have 2, 3, 4 bank accounts at a time. You will go for the best fitting product with the bank that offers the best terms on that. So you're not doing your FX business with the Sparkasse if they are offering non-attractive FX rates. You will do it with Wise just because you know that it's more efficient, or with eBay because you know it's more cost efficient. Meaning for the banks, it's becoming less and less attractive to offer loans, the anchor product at a rate, at costs that are non-fully profit generating. And that's exactly what we're seeing. Banks are either increasing their rates to a loan has to also generate a profit on a standalone basis, or what is actually happening even more often, they're decreasing the approval rates, meaning less customers on a like-for-like basis are actually getting a loan from the banks. And that's exactly where alternative lenders, embedded finance providers can come in, saying that, we have the big advantage that we can make better use of data, because we also see data nationwide. We use different data for risk assessment, or what goes for us, for example, we just have more data because we're in the business for so long already, or what others are doing, or what all others are doing. We're using data more efficient, meaning open banking information, generating transaction data across multiple payment platforms, stuff like that, where we see that by doing so, you can improve more customers without substantially increasing the risk within your portfolio.
I have a slightly different view on the bank side, especially some SMEs need this personal consulting feature, and it's another game, I would say, on the corporate side. But coming back to the original questions of the SME expectations, I would say it comes from a mix of real needs and new possibilities, like, for example, Niclas stated. I would say embedded lending has spoiled them a little bit. Once financing is fast, seamless, and bit like right into their daily tools, there's no going back to paperwork and waiting nights in some cases. So just to give you a quick example of how high SME customer expectations really are these days, you may have heard of it. A failed practical example is the Amazon Germany ING lending partnership. I think it lasted for 5 years, and they ended it just in January because, one reason was that the ING's product wasn't truly embedded. It was more like a traditional setup where Amazon acted as a middleman and showing loan offers to sellers, but then sending them off to ING's website to actually apply. And this like extra step killed the seamless experience customers expect today. So loan volume stayed low, obviously. And I think ING was not so happy with the results, which actually shows embedded lending isn't just about having a partnership. It has to be truly integrated, smooth, and almost, I would say, invisible to really work.
I think that's a quite important point, Ariane, what you're mentioning, because I remember, if I look at us on Tidely, right, what's our value proposition in the market? I see us on two perspectives. The perspective number one is we help SME clients, obviously, in managing their cash flows, which, to my very big surprise, when we started the journey in Tidely, 99.9% of corporates are doing this. If they do it at all, they do this with an Excel spreadsheet. So what they practically do, if they have 4 bank accounts, they log in 4 times into online banking, they download CSV files, upload them into manual Excel spreadsheet, categorize manually, and then do some Kager stuff to understand where my liquidity is going to. It takes them hours and hours every week. So they don't use any tools. So that's obviously how we started the journey. But throughout the last 5-6 years, we have more started engaging with banks to helping them to provide digital cash flows directly into the scoring engines, okay? Replacing tons of paperwork that credit operations still were doing, okay? And that's very different, I would assume, Fabian, with you guys at iwoca, because you don't have the legacy. But banks face this legacy. 10-15% of people somehow do credit operations, right? And in helping them, for me, it became clear. We started trying to help banks with a Tidy logo and the bank logo, 2 separate logos. That doesn't work. It needs to be deeply integrated. Okay. So we take our logo off. It's white labeled. The machine is there for the banks. The customer doesn't really realize it's Tidy. It's the cash flow projection tool, which feeds the scoring engine, which is part of the banking proposition with the logo of the bank. And we also do the same with a couple of non-bank lenders, right? We fully integrate, because my conviction is it needs to be super invisible and super smooth for the SME client and just part of the journey very fluently, right? And then I'm more than happy saying we white label integrate us into the player who's running the customer interface and lending. It's the bank or it's the non-banking lending provider.
Okay, I promise we get back to this later on. Very interesting, but let's have a look at some other important points. Niclas, earlier you have touched on the funding gap, as far as I have understood your words. My next question to you guys is, what impact is the growing funding gap for SMEs having with respect to embedded lending? Everyone knows that this is a pan-European problem. So how does it exert influence on our discussion?
If you look at the statistics, okay, I must admit it was quite new for me a couple of years ago. I mean, the backbone of our German economy is SME, right? So if you look at the statistics, you realize 99.9% are corporates below 500 employees. And their contribution to, gross domestic product is, 70%, 80%, something like this, right? So it's just a massive pillar of the economy. When you go outside Germany, I think the average goes down from 99.9% corporates to 98%. So it's fair to say we have 30 million corporates out in Europe, 98% are SMEs, and they drive economy, right? And if you dry out this machine what is funding? Funding is like the nerve system, the blood system of us human beings, right? You need to fuel this environment that they can operate and manage and grow, okay? If you dry this out, I think it's pretty fair to say the economy will just go down, okay? That's what's happening. And I think this is why we need to constantly keep that machine running, okay? And in these times where convenience, speed, time to delivery is becoming more relevant, and we see economical cycles shortening down, you need to take decisions in real time. You would also expect, or an SME client would expect, I go to 10 providers and I get the loan application and the loan confirmation in minutes. It becomes of utmost importance. So that's why if we're not able to support this important pillar of the economy, we will end up in a quite, I would say, challenging environment. That's at least my macro perspective on this.
Yeah, thank you very much for these words. Really, so true.
Yeah, if they can't grow, neither can the country, I would say. And just to add some figures maybe on that, because if we really want to get to the heart of it, I would like to add some data. I looked up to answer, to have an idea of this question, some statistics on ECB, and I think it's Germany's KfW SME panel, and they show there is not a huge credit crunch across the Eurozone. In fact, in many cases, credit availability even slightly outpaces demand. But that's only half of the truth, I would say. Because when you zoom in a bit, especially on SMEs, and I think you experience that every day, the picture changes. There, the SMEs will tell you, yes, capital might be there, maybe, but getting to it is getting harder. Higher collateral requirements, tougher terms, higher interest rates. And especially in Germany, a lot of small businesses are still struggling to access financing that actually fits their needs. I'm just taking the buzzword bureaucracy. So the problem is not necessarily the capital. I would say the problem is it's not usable. It's like slow, inflexible, or it does not fit how SMEs actually run their businesses. They like it in digital real time, often just looking for this usability gap. So I would say it's less a credit gap, but more like let's call it a functional financing gap. And this gap is closed or being closed, I think, a little bit by embedded lending, or more than a little bit. So there may be no like aggregated shortage of credit if you just look at the figures. But for many SMEs, the problem is getting the right capital at the right time through the right channel. And that's where embedded lending shows its strengths. And that's where also banks, and not also only fintechs, should claim a part in the game, I would say.
Yeah, I would add here that I think that's one of the biggest chances also for embedded lending, that you can use the trust of the embedded lending partner for providing financing to SMEs in Germany that are also often quite conservative when it comes to whom do I actually want to finance with. One thing that we see, iwoca, as mentioned before, is active in both the UK and in Germany. The UK has a share of alternative lending provider and neobanks, meaning new players in the market, providing roughly a bit more than 50% of the loan volume to the UK economy in the SME segment already. In Germany, we have Ariane might know the number even better, but I think we have a ratio of less than 5% coming from that part of the industry. And that's not, as Ariane just mentioned, that's not due to the fact that we don't have enough resources to do more. That's because the demand that is actually there, SMEs looking for loans, are not yet either fully aware of it, or not fully aware that we're a very trustful and well-working, reliable partner for that specific part of the industry. And that's where embedded lending can add a lot of value. We're, for example, cooperating with one of the largest accounting software platforms in Germany, and customers being in their accounting environment can directly apply for a loan from iwoca. And that's where you can combine the trust of the one brand with the financing power and the digital power of the other brand, and therefore making loans more accessible to SMEs in Germany. And that's one of the things, next to the data usage, next to the integration, where we think that embedded lending can provide a lot of added value to the market by layering trust that you can have in certain industry players.
Fabian, I must say I'm quite puzzled about 50% in UK versus, I 100% sure that it's right, but I'm puzzled that the spread is so big. But there's one thing I like what you said. I think it's not the problem that we have not enough funding or liquidity in theory in the market, right? The question is how fast you get this, or how good can you score, and how fast can you deploy the fund, the disbursement, right? And there's a very nice analogy in the payment industry. 20, 30 years ago, when you were doing cross-border payments, a lot was actually documentary-based payments. Right? And the reason for this one is you didn't know your counterparts so well. So you were on the safe side to collateralize a cross-border payment with a document, right? Which is an import-export business. It's very common. But still here, what we see in the last 10, 20 years is that clean payment, non-document-based cross-border payments actually replaced a significant amount of the documentary payment. And the reason why this has happened is because information data was available, that correspondents knew each other much better than they knew before. And I think that's the same here. If we are able to actually push down the data analytics engines to get more information and feeder, fider, however you want to call it, is one of these elements, obviously. But even with open banking, we have so rich information. If we are able to score and analyze the data more in real time, we will go down with the speed of delivery of loans, and that will fuel the industry also to bring the funds which are available to the SME clients. And that is one of the biggest problems that we're currently having, right? And that's one of the challenges the banks, for example, have, because the infrastructure is so legacy driven that they actually cannot cope with that speed.
Okay. Thank you. Very interesting, since you have just mentioned FIDA, and this brings me to regulation, and this is an important point that we need to throw into our discussion. What influence does regulation have with respect to embedded lending? I am thinking here of the fact that you no longer need a banking license to offer financing. iwoca, as we have heard from Fabian at the very beginning, for example, is a balance sheet lender having its own fund in Luxembourg, which is fed by institutional debt investors. The advantage is obvious. The Basel III requirements are, as far as I know, are irrelevant. And on top of that, iwoca are a payment service provider, which allows them to occupy larger parts of the value chain. So once again, my question to you guys, what influence does regulation have?
Just quickly, you said that we're a payment service provider?
Yes, this is what I found on your website, on your British website. Isn't this true?
I hope we don't have that on our British website.
Okay, so I have to check it again. Okay.
I'll check with the colleagues. We're about to explore additional options at the moment. But so as you said, what we're doing is the UK is a different game when it comes to regulations. As you might know, as all of you might know, in the UK, lending to businesses is something which has been non-regulated for decades already. So lending there is something where we obviously put a lot of effort into making sure that we are complying with AML, FinCrime rules, KYC rules, and things that are also protecting ourselves against higher losses and fraud from customers or other players in the industry. In Germany, lending in Germany specifically is, as we all know, normally regulated by KWG, the German laws for lending to consumers and businesses. But there is an exemption if you lend out of a regulated fund in Luxembourg, then being under the Luxembourg regulatory body, where we also have to stick to quite a bunch of rules. As you said, the Basel III regulations are not part of that yet. Our refinancing partners obviously also require us to provide certain equity into our transactions, meaning we still hold the so-called loss piece. We still call it our own money, because if a loan defaults, then it's our risk, it's our default. And that's why we still apply processes and policies as if being a bank, making sure that our standard is as high as a bank standard. And here, mostly also just to protect our own money and our investors' money from defaulting because of weak processes. Talking regulation, I think you mentioned one quite important part, and that's Basel III and equity regulation, equity requirements for providing loans. And I mean, there was, you were referring to a couple of articles happening in the last weeks. There was also an article saying that more and more of smaller banks and Sparkassen are actually applying the individualized approach under Basel to get out of the issues of the high capital requirements for SME loans in certain rating categories. And that's something where we believe that there is definitely an advantage for alternative lenders with non-banking regulatory bodies, because we know that defaults in the, let's say, in the harder to assess area are not as high as many people believe. We see quite attractive risk return profiles in that area as well. And if you have to provide 200%, meaning 16% equity as a bank to this customer group, it's becoming non-attractive because of your capital requirements, not because the sector itself or the bracket of the customer segment itself is non-attractive, just because you have to provide so much more equity compared to a investment grade mid-sized company, that From a board perspective in a small bank, you will always say, hey, let's please focus on the other customer segment because we can generate way more equity return in that area. And that's where we think that on the one hand, better scoring because it allows you to put customers into the right risk group helps, but also a more flexible approach to capital requirements in our refinancing structure is an added value that we can see as iwoca for ourselves, for example.
I 100% agree with you, Fabian, because it's quite interesting to see how, and I'm now first talking about the incumbent traditional banks, right? There was a phase where SME lending was not really attractive for these guys. And I agree with you, Fabian, is the risk return profile is extremely interesting SME segment. It's very interesting. But the problem with the traditional banks were that their risk models and their entire operating model wasn't really prepared for this way of loan application business, right? It was very different. Yeah? The applications came in and they didn't really smartly segment the applications towards a different, size of the customers. Now, over the past years, they've realized that this is an interesting segment and they're trying to adopt their operating model, their credit application model, the scoring model towards opening up this to their balance sheet, okay? Having said this, it's not that easy for these traditional players because they really have complex legacy, okay? And they have now to really disruptively open up this one to be able to deploy loans to this segment. It has a fundamental change requirement to the banks. Huh? So that's where I really see this is where they struggle, but they also see the opportunity. I must admit that if I look at us as Tidely, I'm not that unhappy that I don't fall under any regulation, because I see ourselves more as the accelerator for banks or non-traditional, loan providers like iwoca, etc., BP, to help them to actually deploy relevant information like cash flow in a digital environment and, simulating forecasting, etc. This is a huge help for these players, to much faster, run down the credit application process. So I'm not even sure whether I want to extend this offering because stepping into regulatory requirements is certainly a quite complex issue. And I'm happy that we are not in this so far.
Aria, go ahead.
I think you also wanted to talk about feeder and so on. So I will just hold back what I wanted to say. Just one sentence. I would call it it's regulatory arbitrage, and banks really have to watch themselves, like Niclas just mentions. I would advise them to sharpen their internal models and processes to remain also competitive on pricing. They really need to invest in credit risk analytics. Yeah.
Oh, at this point, I have to jump into the discussion because I am not so sure if this is regulatory arbitrage because since the financial crisis and the disaster banks brought over the world, it is absolutely clear as far as the different economic sectors in the world are concerned, and this is in particular true as regards the European Union, that we don't want to have a situation comparable to the time before 2009, which means that it is a clear goal of politics, of European politics, to have two strong sectors in the European economy, which means that we have the banking sector on the one side, and we have on the other side, we have the non-bank financial intermediation sector. And we are not so supportive of the term regulatory arbitrage because, as a matter of fact, for instance, as regards iwoca, it is really a very highly regulated business. This is no joke. But that's not the point today. What I would like to add to our regulatory discussion here is, Aria, you have just mentioned FIDA, and that's a very important point. How will FIDA exert influence on this embedded lending issue in the future? What's your expectation?
Yeah, first of all, I think FIDA is a great idea because it gives kind of customer-backed control over their own data. And I'm a real fan of the idea of the data-driven economy and open data economy. So with access to fresh data, banks and fintechs can truly understand their customers and deliver a whole new level of user experience. That being said, how will FIDA affect embedded SME lending? I think it's not a simple answer. But it's not a revolution. It's also no game over for banks, I would say. So to break it down, in embedded SME lending, the impact could be huge because FIDA turns financial data from like a locked box into a usable tool. Just with a few clicks of consent, an SME can share their financial profiles like accounts, risk history, tax records, insurance, adding to the PSD2 opportunities. So there are no PDFs, no emails, no frictions. Real-time underwriting is pushed. And it's, however, not an end for the banks. FIDA opens the door to new players, to new competition. I really like that. And fintechs can access credit data directly via APIs. So that lowers indeed the advantage of banks they once had. But banks, can like start from a position of strength here. They already hold rich structured customer data. They're regulated and trusted. And many already have deep experience building secure APIs. So I would say it could strengthen the competition around embedded lending in the traditional and the new landscape and players. So I would say FIDA gives a strategic choice to everyone, to every player out there. You can stay passive and you can, like a bank, get the risk becoming invisible, or you take the wheel and orchestrate smarter embedded journeys. So FIDA will test banks, not on size, but on agility, on mindset. And FIDA is complex. It requires real investment, real transformation from every player of the ecosystem. But because I'm also taking the lead for banks here, it's also the opportunity to reinvent their role, I would say, from like gatekeeper of credit to enablers of smart contextual financial experiences. And I'm speaking with many banks. It's quite clear they're not just ticking a regulatory box, like just being compliant with this regulation. I don't really like it. They're actively exploring concrete FIDA use cases, also having a lot of partnerships in mind, and see it as strategic opportunities to step into the role of smart data users, not just data users, and thinking here of embedded journeys as well. So I think it will give the whole flywheel of embedded lending new power, I would say.
I would like to add what Aria said. I think banks have one big, so we talk about SME segment, right? An SME segment is, I would still call it a very traditional segment. So I think over my past 5 years, I minimum spoke to 1,000 SME clients live, to really understand what are they looking for. And banks have one big asset still they have, that is trust. Okay, a lot of SME clients trust their banks. Maybe it's tax accountant bank, and then it's hopefully not the wife, but at least there's a big trust, right, towards the banks. And they still can benefit from this mega asset they have. Now, the interesting thing is, how fast will the paradigm shift go from efficiency-driven decision-making from SME clients to from trust-driven decision-making to efficiency-driven? Okay, and this is where I think the banks get a lot of pressure from disruptive players like iwoca, because what iwoca is very smartly doing is giving a super convenience and customer experience to SME clients. And obviously this dynamic will more go into the industry and shifting the decision-making process from I trust in my bank, I accept it takes 3 days, towards no, it really has to happen in real time. Okay, that's a dramatic paradigm shift. Now, if you look on the banks, the biggest banking problem I see is strategically everyone agrees FIDA is super important. We can do a lot of cool stuff with FIDA, blah, blah, blah. But then it very quickly goes down to a technical level. Okay, and when you look at the tech resource of banks, 98% of the tech resource and budget is a maintenance, infrastructure, regulatory, compliance, AML. It has nothing to do with strategic topics, right? And this is the problem. Banks need to very radically change the operating model to be able to prepare themselves when trust goes down and convenience goes up. And that is the biggest challenge the banks are facing. And I think this is for in the next 2, 3, 4, 5 years, they really need to change this. And then the key question is, can you transform out of the core, or do you need to completely build up a new model in banking to be able to cope with the speed that non-banking providers like iwoca have, because they don't have legacy complexity, right? So I think that is one of the biggest things to be seen in the coming years. It's very clear that FIDA is a huge, huge benefit, right? But the question is, who can, how fast benefit from this? Huh?
Okay, let's perhaps go to the heart of the matter here. Okay, what's the ask here? After we have heard so much about trends and customer expectations, funding gap, regulation, Basel, FIDA, or FIDA, are we talking about nothing else but the disruption of SME lending when we say embedded lending? Are we talking about who will be ultimately the manager of the customer relationship, of the customer interface? Is this core of the whole discussion?
I would disagree. Why? Because what I said before, I think there is more than one channel to the customer. Embedded lending always includes the idea of the lending provider being embedded somewhere. Customers can also directly find the lending provider, meaning a very relevant channel for us is our just direct business, being online marketing and customers finding us directly. The added value of embedded lending, if we're, for example, talking about FIDA, isn't coming through embedded lending. A customer can also grant us with access, open banking and FIDA and whatsoever immediately, directly. We don't have to have an embedded partner there. So I think the future is a combination of different channels towards the customers, but it's also creating more trust in the market. Here, I'm talking especially about Germany, by making use of different reputations, different trust levels that are already given in the market. And as many know, we and other players are also cooperating with banks, for example, meaning financing those customers that banks can't finance at that moment in time. And the customer there is getting the information from their bank advisor directly. Hey, why not? We can't do it at that moment in time because your company is too young, because we don't finance a specific topic whatsoever. Why don't check with iwoca for a loan? And that's where the trust level is quite high, and where we say that, hey, an embedded solution, embedded customer journey is creating a lot of added value. But I don't think that it's embedded lending changing the SME industry or SME lending market completely. It's enriching the market, and it's at the moment improving access to customers, and therefore also growing the market. And that's coming back to the macroeconomical part. That's where we believe that there's quite some added value for Germany as a macro market, by just providing more liquidity, more working capital, more financing solutions to SMEs that are struggling to find the right solution at the right moment in time. They don't struggle to, as Aria said, to have access somewhere. They just don't know where the right access is at the right moment in time. And therefore, keep in mind that an SME with like 10, 15, maybe 20 employees, they can't invest days and days or weeks and weeks into finding the right financing solution. It has, as Niclas said, it has to be fast. It has to be there once they're looking for it. If you can get this special discount on the purchase contract if you do it by tomorrow evening, and then you have to wait 8 weeks for your bank to respond if they're even interested in checking the loan, it doesn't help. You have to have an immediate feedback from your financing partner. And that's where we believe embedded lending can add a lot of value to the market. But I don't think it's completely changing the industry. It's more enriching, enhancing, and improving the industry and access to liquidity for SMEs.
Constantin, I would like maybe one additional perspective on this one, right? I think the smaller you get in SME, and maybe SME is maybe an even too big definition, right? You have micro businesses, you have medium-sized businesses, and you have the larger SME businesses. The larger you get, the more transactional things become. The smaller you get, the more relationship trust comes, okay? And I would have a tendency to agree with what you said, Constantin, is who owns the customers becomes super important the smaller you get in terms of SMEs, okay? Now the question is, owning a customer does not really mean that you provide the product itself, right? So you might be a smart customer interface, and the customer doesn't realize that suddenly the loan is being deployed by iwoca. Okay, he just has a great experience. He clicks on it, bam, 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 and suddenly he gets the loan on the account in seconds, and he's just happy. And for him, the partner is the customer interfacing platform. Okay, so I think what we will see is a quite interesting, and I wouldn't call it ecosystem solutions, because ecosystem is such an old expression. Years I spoke about these kind of ecosystems as a consultant, but in principle it is like, I go for a loan, I have my interface, I have accounts, term deposits, and I look for a loan, bam, I get the loan on my account, and maybe it's even provided by iwoca or by another platform. I don't care. Okay, it's just there. And I think this is where banks have to change the way how they deal, because today they still own 90% of customers. That's what they own, right? And that is going to be relevant for the banks. How do they, if they turn around the operating model below the surface, I think they really need to change. And then we will, I don't know how to value the banks where UniCredit. I mean, from my outside perspective, it looks like UniCredit realized SME business is interesting, but our scoring model doesn't work. Okay, we partner with banks where it could be, right? So there's a lot of this complete radical rethinking, but owning the customer is, I think, quite an interesting, relevant proposition, to be very honest.
Yeah, I think it's a very tricky question, and I agree with Fabian's disagreement that it's not disruption. Coming back to your question, if embedded lending is like disrupting the traditional lending. So disruptions means like a big, often sudden change in how market works, like breaking with the established market rules. And I think we don't really see this. So we see evolving technologies, but no disruptive technologies or business models that shake up the old players and make like banks redundant. They are still the central part of our financial stability system. Like, think about the steam engine. Back in the day, it completely changed how goods were made and transported, kicking off the Industrial Revolution. And I would not compare this with embedded lending, but that should not like make it less relevant, the embedded lending trend. I would say it's, embedded lending simply amplifies the way of distributing capital, and it changes where and how loans appear inside marketplaces, ERP system, payment tools. And instead of cutting banks out, it builds on their strengths, capital, risk, expertise, compliance, but they also need to adapt to this new situation, like Darwin's survival of the fittest, so those that can adapt the best. And it combines them with the speed and the agility of modern platforms and fintechs. So I would just say it's not a pure disruption. It's like the natural evolution of, let's say, credit delivery, and marrying bank strengths with digital agility of new players, learning from each other to meet customer exactly where they are, because customers are in the center of all our discussions, I would say.
Yeah, absolutely. Thank you very much for these final words. And thank you, guys. That's the end of today's show. It was a huge pleasure to have you in our show. And Ariane, Niclas, and Fabian, hope to see you next time in our podcast.
Thanks a lot, Constantin.
Thanks a lot, Constantin. It was great.
Thank you very much.
Thank you, everyone, for listening. You have hopefully also enjoyed this episode. Please make sure you subscribe to our podcast and save the date already today. The third Digital Lending Summit is going to take place in Frankfurt on 1st of October. More information in our show notes. Stay safe and sound, and see you soon.